The basic issues in accounting for notes receivable are the same as those for accounts receivable. However, we need to also consider two issues that do not apply to accounts receivable: determining the maturity date and calculating interest. This video will focus solely on notes receivable. Companies may grant credit in exchange for a formal credit instrument known as a promissory note. This gives the holder a stronger legal claim to assets than do accounts receivable. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. Promissory notes may be used when individuals and companies lend or borrow money, when the amount of the transaction and the credit period exceed normal limitations, and in settlement of accounts receivable for customers who need to extend the payment. The majority of notes, however, originate from lending transactions. Maturity date is the date when final payment of the note is due. It is also called the due date. The maturity date of a promissory note may be stated in one of three ways: on demand, on a stated date, or at the end of a stated period of time. Note terms are expressed in either months or days. The formula for computing interest is PRT, or principal times rate times the time period. P represents the principal or the face value of the note, R represents the annual interest rate, and T represents time in terms of 1 year. The interest rate specified on the note is an annual rate of interest, so the time factor in the calculation expresses the fraction of a year that the note is outstanding. When the maturity date is stated in days, the time factor is frequently the number of days divided by 360. The time factor is the number of days out of a 360-day year. In this example, 120 divided by 360. Financial institutions use 365 days to compute interest. For homework problems, assume 360 days to simplify calculations. When the maturity date is stated in terms of months, the time factor is the number of months divided by 12. In this instance, 6 divided by 12. When the maturity date is 1 year, you simply multiply the principal or the face value of the note by the annual interest rate to obtain the interest. To illustrate, Brent Company signed a $1,000 2-month 8% promissory note dated on May 1st to settle their open account with Wilma Company. Wilma Company will make the following entry to record the note: debit note receivable for $1,000 and credit accounts receivable Brent Company for the same amount. Like accounts receivable, companies report short-term notes receivable at their net realizable value. Valuing short-term notes receivable is the same as valuing accounts receivable. The estimations involved in determining net realizable value and in recording the proper amount of bad debt expense and related allowance are similar. Notes may be held to their maturity date, at which time the face value or principal plus accrued interest is due. In some situations, the maker of the note defaults, and the payee must make an appropriate adjustment. In other situations, similar to accounts receivable, the holder of the note speeds up the conversion to cash by selling the receivable. A note is honored when it is paid in full at its maturity date. For each interest-bearing note, the amount due is the face value or the principal plus interest. A dishonored or defaulted note is a note that is not paid in full at maturity. If the lender expects that it will be able to collect, the two parties negotiate new terms. If there is no hope of collection, the note should be written off. To illustrate, assume that Wolder Company lends Higley $10,000 on June 1st, accepting a 5-month 9% interest note. The amount due at maturity is $10,375, which represents the principal or face value of $10,000 plus interest of $375. The entry to record collection would result in a debit to cash for $10,375, a credit to notes receivable for $10,000, and a credit to interest revenue for $375. And as you can see, the interest is calculated by taking that principal or face value of $10,000, multiplying that by the annual interest rate of 9%, and prorating that for the 5 months that it is outstanding. Let's assume that Wolder Company prepares financial statements as of September 30th. We would need to record 4/12 of interest on September 30th. So the entry would be a debit to interest receivable for $300 and a credit to interest revenue for $300. At the note's maturity, Wolder receives $10,375, so we debit cash for that amount. This amount represents repayment of the $10,000 note, as well as 5 months of interest, or $375. The $375 is comprised of the $300 interest receivable that was accrued on September 30th, plus $75 that was earned during October. This is the entry to record the collection of the note. The solution to this exercise will be provided in another document.